in this era, we're getting rising populism over the past decade or so because we have unusual monetary conditions, fiscal conditions, economic conditions. And so this is one of the avenues where it's taking place, but it's a sense of people kind of taking back some semblance of control in their view.
Physical silver and gold in your hands, personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com. Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update, and back with us today, one of our viewers' favorite guests, Lynn Alden from linalden.com. Lynn, thank you so much for joining us today.
Thanks for having me again. Happy to be here.
Definitely. It's great to have you. And the first topic I'd like to discuss is the GameStop situation that we saw really at the end of January, beginning of March, and also the SilverSqueeze. Now, it seems like we're seeing sort of a revival of that, especially in GameStop right now, as we are actually approaching the all-time high it made. Right now, we're seeing GameStop over $300 per share. What is your take on this whole situation that we've seen of kind of this attempt to squeeze different stocks and also the commodity markets, silver?
Yeah, there's a couple things going on here. And so one is, if you look at retail participation in the market, we're at levels not seen since the late 90s. We never really got a lot of retail investor participation in the previous recession when we had that big dip. A lot of people really didn't get into the market. And even though that bull market progressed for a long time, we never got a lot of young investors in. And it's really in the past couple of years when Robinhood and other brokers brought their commissions down to zero. We got fractional shares at many of these places. We really gamified the markets. And so we have a lot more retail investors in now than we had pretty much any other time. And then unlike the late 90s, they're more coordinated than ever because social media is so much more advanced. And so back then they had message boards and things. But now we have, orders of magnitude more organization, massively larger platforms where these people can coordinate their, attacks, you could call them. And so what we saw with the GameStop situation is that some of the more sophisticated traders out there noticed that some of these stocks are trading at extraordinarily high short interest, meaning that, basically the amount of shorts piled onto the companies was huge, in some cases over 100% of the shares, which really shouldn't happen. And so they basically are vulnerable to getting squeezed if enough people buy the shares or buy options on the shares. And so we saw that play out. But then, of course, that starts causing market dislocations. Brokers can only, they only have so much collateral, to be on that side of the trade. And so we started to get the controversial aspects of some of the brokers, halting the buying, and that gave the hedge funds time to basically get out of their positions. And now we're seeing some of a revival of that because, some people come in, they try to reshort it, and now that short interest is down, and they think that the situation's over. And you have retail investors constantly monitoring these things, trying to rally the troops again and go with another attack. And so, we're seeing that play out. And I think that goes in the broader kind of populist sentiment we're having across multiple things, not just financial markets, but basically in this era, we're getting rising populism over the past decade or so because we have unusual monetary conditions, fiscal conditions, economic conditions. And so this is one of the avenues where it's taking place, where the sentiment is that, okay, if so many things are manipulated, then we're gonna fight back. We're gonna organize and use our numbers and mess with some of these institutions that at least we perceive. Now, whether or not those individual institutions that end up being on the other side of this are actually, the big bad here is really not, I think, the main thing. But it's a sense of people kind of taking back some semblance of control in their view.
Definitely, and I think that's definitely one of the reasons why people have been moving into precious metals recently, is kind of taking back that autonomy, right? Taking back that ability to hold wealth in their own possession. Now, we did see kind of that same sort of squeeze in the silver market. The whole month of February, at least for us at Miles Franklin, was the busiest month we've ever seen. The demand is pulling back a little bit. It's still way above what we saw pre-COVID. But I guess your perspective on that, do you think this move into precious metals, and especially silver, this silver squeeze, what is your perspective on that first? And then do you think it's over, or have we just kind of seen the beginning of it?
Well, so kind of like how people perceive the equity markets as manipulated, they also look at the precious metal markets and see that any commodity with a reasonably high stock to flow ratio, like especially gold and then to a lesser extent silver, but then silver is a smaller market, and so but anyway, those are easier to manipulate than say copper or oil, because they're consumed almost as fast as they're produced. Whereas when you have a large stockpile of a metal and then you have a situation where you have more paper claims on that metal, more people think they own gold essentially than really own gold, is another way of describing it. And so, there are occasions in history where that illusion can break if everyone kind of wants their gold at the same time, and it's basically a game of musical chairs. But as long as there's not that extreme squeeze for it, the situation works, and basically more people have exposure than the metal that exists. And so, of course, some people that saw the GameStop snare saw that, hey, silver's a pretty small market. It has this paper aspect to it. Maybe we can go after that. Now, silver is a much bigger market than GameStop. So there's a couple extra zeros in there for the market capitalization. So that's a much harder market to target. But that doesn't stop people from doing their part to try to kind of cause that to happen. And we have seen, whether it's with gold, silver, or Bitcoin, the idea of self-custody or, basically having wealth outside of the system has become increasingly popular in recent years. I mean, that was kind of the whole development of Bitcoin, with the technologies that allowed that to happen to kind of fall into place over the past couple of decades. And then, of course, the traditional mechanism for that is gold, silver, or privately owned real estate, farmland, things that are kind of outside your brokerage account or your 401k. Now, whether it's going to continue, I would actually defer to you guys more than me, because you see the volumes and you can kind of track that in a much faster way than I can. So I would leave that to you.
What we've been seeing is definitely more demand that we've seen pre-COVID. So, it is anyone's guess, is this going to continue or not? I know a lot of people think it is going to continue. But one of the things that I wanted to ask you about is kind of what we've been seeing in the metals recently is a little bit of a pullback ever since the beginning of February. And one of the things that people are pointing to is the rising treasury yields, right? Other people are saying, well, the fundamentals for precious metals are better than they've ever been. So what is your take on what's truly driving the precious metal prices?
I would say for the most part, real interest rates, specifically the 10-year minus the break-even rate, is one of the most correlated metrics. And so over multiple decades, gold has a number of partial correlations, like to the dollar and other things, but none of those are particularly strong. The main things that I use to track gold are, one is growth in the broad money supply. So over the very long run, gold tends to keep up with the rate of basically dollars being created, because essentially gold's got a very low inflation rate. We're only making so much of it, whereas the dollars have a much larger monetary inflation rate. I'm not talking about CPI, but in terms of just monetary inflation, so the amount of broad money in circulation. And so gold kind of keeps up with that over the long run, and then it overshoots or undershoots it largely based on what real interest rates are doing. And so if you can, if say inflation's 2% and you can go buy a 5% yielding treasury, that's actually pretty attractive. That creates a pretty high opportunity cost for owning gold, because gold is your zero yielding kind of, inflation resistant asset. If anything, it has a mildly negative yield because you have to pay to own it. You pay, store it, pay transaction costs, things like that. But essentially, it's been called a good, honest zero. It does what it does. Whereas if you can get a 3% real yield on a treasury, that's pretty attractive. However, when inflation's 2%, your treasury's 1%, now you're at a negative 1% yield on your treasury. Well, suddenly that zero yielding gold looks a lot more attractive, because you basically get inbuilt inflation protection and a zero yield. And so in that situation, people flocked more towards gold. And so what we're seeing now is that ever since August 2020, we're seeing a rise in nominal yields, and they've gone up faster than inflation, which was the opposite from 2018 to 2020, which is we saw both inflation, officially reported inflation came down because we got a slowing economy, but then 10-year yields came down even faster, from well over 3% down to like 0.5%. And so we had the real yield go from roughly 1% all the way down to roughly negative 1%. And since then, we've been, it kind of started trending sideways a little bit for several months as treasury yields were rising a little bit faster than inflation. And then particularly in this past move, when we're starting to get kind of the reopening euphoria, we're starting to get the vaccines are going out, and oil's back up, and that's all kind of going on. we're getting higher, 10-year yields and other yields, while inflation's, not really coming through the numbers yet. It's kind of sideways for the moment, and so we're getting an uptick in real yields. Now it's still negative; it's just less negative than it was, and so that's been putting pressure on gold and to a lesser extent silver all the way since August. And I think that would continue until a couple things happen. One is this summer we have really good base effects for inflation. So we got that, the dip in CPI for March, April, May of last year. And so when you have the year-over-year numbers from March, April, May of, coming up in the next 3 months, those are going to be probably pretty substantial headline numbers. Now, whether or not those persist, I think is an open question. But market participants that are not really aware of that might get a little bit of a shock if they're not kind of watching the base effects. And so that's kind of one potential catalyst where you could get, inflation kind of catching up with some of these rise in nominal yields we've seen. And then the other possibility is that if the rising yields cause more and more market problems, you could see the Fed come in and push down the long end of the curve, and that would keep real rates more negative, and that would be generally pretty good for precious metals.
Now, some people might say, well, if real rates are still negative right now, then gold should still be more attractive than bonds. So wouldn't we still see gold rising right now?
You'd think so, except the way, the market really focuses on a rate of change more so than absolute numbers. And so that's why, gold is still elevated compared to where it was 2 years ago, for example. But it's just weaker compared to how it was in mid-2020 because that rate of change has gone against it. In addition, it's not just bonds that people are, bonds have been, kind of weak lately. It's really kind of the equity market, potentially the crypto market, because that's, you've had not only the rise of Bitcoin, but you've had Ethereum do well. You've had all the altcoins do well. You've had, people buying like $600,000 gifts, like the non-fungible token collectibles. You kind of have these other areas that people are playing in. And so when you have that headwind of the rising real yields and these other kind of play sets around, gold has just not been one of the more attractive things to participate in. And if anything, I mean, things like copper and oil, even for a natural resource investor that still prefers natural resources, some of those more cyclical ones have been more attractive than gold in this environment. But once we get to some sort of cyclical kind of turning point, that can easily roll over back in gold's favor.
Another thing that people look to when they are deciding whether to hold gold or not is the stability of the economy, right? And that's something that was a big shock when COVID hit, that, okay, we're having this economic crisis. And you've stated that really it's the biggest economic shock in modern history. And the response to it, the fiscal and monetary response to it, was really the biggest we've seen in modern history as well. Taking that into consideration, where do you see the economy headed and how do you see that impacting the gold price?
So in the near term, I think it's going to be pretty strong just because we just, roughly today, we're probably getting the $1.9 trillion stimulus signed. It's already pretty much good to go. So that'll be stimulus checks to people. That'll be pretty big child credits. That'll also be extended unemployment benefits. And so that kind of keeps the game going because that keeps people from defaulting on their rent. That keeps people from, having these other issues. They can reduce their credit card debt. You get that kind of burst. And some of them can put it away in savings. Basically, it depends on your income spectrum. So if you're kind of middle class, you're probably going to spend some of it, but save a big chunk of it. If you're kind of on the lower end of the income spectrum, it's all going to go off to like just basically keeping yourself solvent. It's going to go to rent. It's going to go to food, things like that. And so basically, there's no sign that things should come to a halt in the next 3 months or so. Now, it's kind of as we look later this year, as that effect starts wearing off, the market's going to say, okay, what's next? What are we looking at now? In addition, right now, when we look at earnings reports coming out from companies, they have really easy base effects, right? Because Q2 of last year was the bottom. That was the GDP bottom. So things started to get bad in spring, but then it didn't really kind of come through the numbers in many cases until that second quarter. And so as companies report their quarter one, quarter two numbers year over year, they're not going to look that bad because you're comparing it to a dumpster fire of what they were last year. And so it's not really kind of until the end of the year where I think, the market's going to say, well, now what? We already got the bounce back and stimulus is kind of, wore off at this point. And then so the market's going to say, what's next? And that's where I think you run into potentially more of a kind of a rollover or at least the deceleration of what we're seeing now.
Do you think what we saw at the beginning of the COVID crisis that was the worst we're going to see, or do you see a greater crisis coming in the future?
So I think in terms of speed, that's about as fast as you can get. I mean, that was a tens of millions of people lost their job, practically in weeks, and then the market went straight down like a cartoon. That's kind of a very specific situation. But I think that some of the next kind of challenges for the market are this kind of push and pull between higher treasury yields. Because if you do start to get higher, prints in the official inflation numbers, and you start to see broad money supply continue going up, as it should from this, this recent stimulus should be positive for the money supply. If that starts pushing up treasury yields, that can put a lot of downward pressure on some of these highly valued tech stocks, which make up, some of the larger percentage of the market capitalization of the U.S. equity market. And so if you start to see issues there where the bond market gets disorderly, we saw hints that, a couple weeks ago where we started to see disorderly bond market action. And if we start to see that more persistently, that's where I think you get another kind of round of crisis. And then it comes down to how fast does the Fed intervene to kind of quell that fire. Because from the Federal Reserve's perspective, they'd prefer not to control the long end of the Treasury curve, at least not explicitly. They'd rather keep their current rate of buying of, quote, only $80 billion a month in treasuries, not really having any explicit yield targets, because last time they had yield curve control was all the way back in the 1940s, and they essentially lost their independence for 9 years. Now, even now, I mean, they don't have complete independence, but back then they pretty much had no independence because their balance sheet had to adjust to whatever it was in order to cap the yields. They basically, they said, okay, the 10-year is not going over 2.5%. And we're going to buy any number of 10-year treasuries to make sure it doesn't go over 2.5%. So you pick a number, but then you lose control of your balance sheet, and you lose control of the value of that currency, because that's basically the release valve for that other choice. And so the last thing they want is to do that again. So that's why they have that option on the table, but it's kind of like they're not going to pull that out unless they're forced to by the market. And so the market would have to get pretty disorderly in order for them to resort to that. So you have a couple things ahead of time. One is we might see an extension of the SLR rules change for banks, which allows them to buy more treasuries. That's set to expire at the end of March, but that could be extended. We also could see potentially an Operation Twist where the Federal Reserve says, we're going to sell some of our shorter end, shorter duration treasuries to buy some more longer duration treasuries. So those are some of the more like kind of moderate options. And then their nuclear option is outright yield curve control, which is, like I said, something they're not really kind of resorting to just yet. And so I think as we get to that point, if we start to see that persistent rise in yields, that's when we start to get kind of more market disorderliness.
Do you think the Fed is going to be able to control the chaos in a sense? Because, I mean, you mentioned also like the market and the stock market. You've mentioned on your blog that really, if we look at the cyclically adjusted PE ratios, it's historically very overvalued, right? So what happens if we just start seeing a collapse of the stock market? What happens if we see these kinds of things that could happen? Is the Fed going to be able to stop that sort of a crash?
There's a saying in engineering that's like it's like good, fast, or cheap. Pick two. And the point is, you can make a good product quickly, but it'll be expensive, or you can make a good product expensive. You basically can't do all three variables. You can't solve for everything at the same time. And so when it comes to the Fed, they can, whatever variables they're going to try to control, they have a lot of power to solve for those variables, but there's other variables that get used as a release valve. And so, for example, if you try to solve for yields, then you lose, the release valve is the currency strength. On the other hand, if you let yields kind of settle where they're going to settle, that stops or at least slows down the descent of the currency. That's what we've seen over the past, since August, really. They've let yields go up, and so that's kind of stopped the dollar from falling as much as it was, and stopped precious metals from rising like they were, at least temporarily. And then it's important at that point to kind of identify the bottlenecks. And so the overall bottlenecks is with so much debt in the system, they can't let yields rise too much. It's very different than the 70s, which is when we had very low inflation. Very low debt, And so they were able to raise interest rates in order to control inflation without kind of bankrupting the system. Whereas the situation we're in now is more like the 1940s, where the variable that they have to solve for is they can't let yields rise too much because that bankrupts everything. And so they're more likely to let the currency eventually kind of take the hit there. But they're, like I said, they're not likely to resort to that unless they were to get a significant market turbulation. And so overall, it's hard for stocks to have a persistent decline if the broad money supply is going up rapidly and yields are controlled. If you have yields going up, that can pressure, like we saw in the 70s. But if you have those two things in place, it's really hard for stocks to fall persistently. And that goes back to the thing of, like, if you look in local currency terms, what are some of the best performing stock markets? Well, Venezuela. And so it's hard to get them to go down in local currency terms when the currency itself is taking the hit. And so overall, I don't have positive views on the inflation adjusted forward stock market potential. Its absolute potential will largely depend on what the Fed decides to do with its currency. And also, I prefer to look at kind of individual stocks or sectors more so than the broad indice. And so I've preferred, certain stocks or certain sectors that are less, expensive compared to some of the really high flyers. I think the more vulnerable part of the market is those unprofitable tech stocks that are trading at, 30, 40, 50 times sales, based on the idea that disinflation is going to be here forever, low interest rates are going to be here forever. And so you start to get an uptick in either inflation or yields. They're the ones that are pretty pressured. Whereas if you look at, natural resources, if you look at some of the kind of higher quality value side of the spectrum, I think some of those still look pretty reasonable compared to alternatives like holding cash, for example.
Now, one of the alternatives that we also pointed out the last time we had you on was Bitcoin, and you've been talking quite a bit about this. And last time we had you on, you were bullish on Bitcoin, and we saw quite a rise, up to over 50,000. As where Bitcoin is today, are you still bullish?
I am bullish, but it's all a matter of perspective. And so I know I was on several months ago. I figured the exact price, but yeah, we've had a really kind of parabolic move since then. And so when I originally got bullish in April 2020, it was under 7,000, and then it got up to 9, 10,000. I was still super bullish. Once it started to get up to 30, 40, 50,000, I'm still bullish, but it's less asymmetrical than it was in 2020. And so I still think 2021 is likely to be a good year for Bitcoin, but it is something to kind of monitor now that we have had a pretty sharp rise. And so if you actually look at kind of previous Bitcoin halving cycles, so every 4 years it has a supply flow halving. It tends to have a really good 2 years after that. And if you look at on-chain indicators, like what are the long-term holders doing? What are some of the different metrics, like say market capitalization compared to realized capitalization, which is essentially a measure of cost basis. A lot of those still look pretty mid-cycle in terms of overall price run, or maybe 60% into the cycle, the fifth or sixth inning at most. And so overall, my base case is that I still think we're going to see notably higher Bitcoin. But in terms of the multiple of the move, I think we've had a big chunk behind us. And now, I mean, even if you get a double, that brings you to six figures, but that's a much smaller percent move than going from 7,000 to 50,000. So I'm still bullish, but it's a matter of, it's a spectrum.
Definitely. And with respect to Bitcoin, you've also noted how it's very different than actually other cryptocurrencies. And it's kind of special. You mentioned how really the growth in it has been very organic as opposed to a lot of the other ones.
Exactly. So if you look at a lot of them, I mean, Bitcoin came first. And even in that sense, they didn't invent the blockchain. They basically brought enough pieces of technology together with a really good incentive mechanism for difficulty adjustments and supply halvings and things like that. Basically brought all the right technologies together, made the system. And it was launched in a very kind of, quote unquote fair way. It's not like the creator gave himself a ton of coins and then started selling the others. Instead, he put it out right from the beginning. Anyone could start mining it. The original creator had no advantage, no pre-mined coins. They basically had to mine just alongside anyone else. And if you look at, Twitter, within a day of Bitcoin being launched, there was already kind of Hal Finney on Twitter saying he's running Bitcoin. It was already a public creation. And if anything, Satoshi showed the secret before he even launched the software. He basically showed the white paper a couple months prior to the launch of the actual software. So it was more about launching a protocol rather than kind of launching a security. Whereas a lot of the later ones that kind of tried to copy or improve Bitcoin, they would do what's called a pre-mine, where the creators give themselves a lot of tokens and then they launch this thing, and it's more like an equity offering. And then you have kind of a central promotion hub, recommending this coin and trying to get it on exchanges and kind of being a marketing force behind it. Whereas Bitcoin, I mean, the original creator kind of disappeared, and then you have kind of different factions. There's no kind of central hub. There's no official Bitcoin organization that runs the whole thing. It's kind of like Fight Club in that sense. It's like this decentralized thing with the creators just off in the shadow somewhere. And so overall, Bitcoin has that going for it. And then it has first mover advantage. So it has it has a stronger network effect. It has a higher hash rate. So it's much harder to attack if you were to try a 51% attack against it. It basically has that overall kind of security advantage. And so if you're a large institution, you're not going to mess around with one of the smaller coins that that someone can kind of hack pretty easily. You're going to go with the bigger coin if you want to have exposure to that space. And so overall, it has a lot of that trenched advantage compared to some of the competitors. And then, of course, from there, you have the hardware ecosystem, like the types of wallets or the types of service providers and apps that use it. Things like Lightning, where you can have a second layer on top of Bitcoin and do kind of micro payments between different entities. A lot of that's developing on the Bitcoin network. And so really, along with Ethereum, there's only two main protocols, Bitcoin and Ethereum, that have a substantial network effect. And then between the two, Bitcoin's the one with the harder money supply and the more decentralized kind of leaderless protocol-like nature to itself.
Now, to kind of wrap up, when we're seeing the emergence of these new technologies and a lot of new things, and we see the financial system in possible turmoil, like very uncertain, I guess for the rest of the year, for 2021, what is your perspective on kind of what specific assets are you looking at to take advantage of really these times that are unprecedented in some ways and changing technologies?
I have a couple kind of major pools of capital that I think of it, and they kind of benefit from different situations. And so I think one of the longer term kind of beneficiary here is assets that are scarce or finite, like hard assets. So that could be high quality real estate, that could be gold, silver, that could be copper, that could be oil, that could be uranium, that could be Bitcoin. And so I have that diverse basket, and there's different parts for it that do well at different times. And so, for example, from 2018 to 2020, the gold component did particularly well. Silver did pretty good, whereas like oil and copper kind of languished. But then from 2020 onward, we've had copper do really well. We had oil come back, and so they kind of take turns, in leadership roles. Same with Bitcoin. I mean, it didn't do great in the early part of that, and then once I got in, and I didn't really add that to the mix till 2020. That's done very well, but I expect there'll be years ahead where Bitcoin's not doing very well, and maybe gold's doing well again. And so I like that basket of kind of finite assets, and also their producers in many cases. So gold miners, copper miners, royalty companies. And then, one of the ways I'm playing this kind of rise in yield is actually financials. And so even though a lot of financial, companies like banks are vulnerable in this environment, when you have the money supply going up substantially and you have treasury yields going up, that's actually a very good environment for banks. And they've actually been hedging my precious metal positions because, if you look at basically all the things that are pressuring gold at the moment have been beneficial for banks. And so I have that kind of barbell approach where until we get something like yield curve control, I think banks can do reasonably well. And so I have that mix of value equities, a couple growth equities, and then big focus on that finite value space. And then I hold T-bills for kind of a dry powder if we get liquidity shocks, if we get broad drawdowns. That's money that can rebalance into some of those more attractive assets to kind of overall just improve the risk-adjusted returns as we go along this macro environment.
All right. Well, Lynn Alden, thank you so much for joining us today. If people would like to hear more of these interviews, they can hit the subscribe button and the bell icon. And before we let you go, Lynn, where can people find you online and subscribe to your newsletter?
So I'm at lynnalden.com. That's where my primary content is. I'm also on Twitter at lynnaldencontact. And thanks for having me.
Definitely. Thank you so much for your time, and God bless. Physical silver and gold in your hands. Personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com.